Okay, next up we have the IVE Group, and presenting today is the IVE Group Executive Chairman, Geoff Selig. Geoff, welcome.
Good afternoon. My name is Geoff Selig, the Executive Chair of IVE Group. What I'd like to cover today in the time that we have is just a brief overview of the company, touch a little on our clients and diversity of clients and some customer metrics, walk you through the FY24 H1 results that we released at the end of February, and then touch on a couple of growth initiatives, and then finish off with the FY24 full year guidance before we move into Q&A. So this is a business that was started by my grandfather 103 years ago, 1921, when he started a suburban newspaper in Balmain after returning from the First World War. So today we are roughly $1 billion a year revenue business, and we've managed over the last 20 years to diversify and grow from what was a printing business to quite a diversified, in fact, I'll get rid of those notes. I'll just do it from, to quite a diversified, integrated marketing business. We've got about 2,000 staff, predominantly across New South Wales and Victoria, with teams up in Philippines and in mainland China as well. The best way to describe our offering is across these core areas. Creative services is graphic design. We have 60 graphic designers, some of them are on staff with clients. We create content basically, whether that's for printed channels or whether it's for social media or digital channels. It's all about creating content, which is creative services. Data-driven communications is one-to-one personalised communications. You may have heard the term direct mail. It's direct mail, targeted, it's driven out of data, and it's both paper-based communications and also electronic-based data-driven communications. Our e-commerce marketplace is called Lasoo. I'll touch on Lasoo a little later in the presentation today. Brand activations, or some other words for brand activations, think point of sale, in-store merchandise, retail display. So that ranges for us, and there's some photo examples in here, anything from an El Paso cardboard construction in a Coles store right through to a fit out of a Vodafone store. So our brand activations division produces quite a broad range of in-store merchandise, some of it cardboard right through to fit outs that have electronics and metal and fabricated timbers and so on and so on. It's a very important part of our business, and I'll pick up on that a little bit later. Premiums and apparel. Apparel is basically uniforms. So if you took Certis, who manage all the security at airports around the country, we do all of the uniforms for Certis. Or for Reece, we do a lot of clothing for Woolworths. So it's just general apparel. We don't produce it, it's through our supply chain. And then premiums is branded product. Anything with a brand on it, whether it is a drink bottle through to an umbrella, hundreds and hundreds of different types of branded products. That's in our premiums and apparel business. Packaging is a new sector that we've just entered into recently with an acquisition on the 30th of October last year. So I'll talk about that a little later. A very exciting opportunity for us to grow that part of our business. And then the second last part of our offering is print. We are the largest printer in Australia by a long way, Park Newspapers. So we do three different types of print. General commercial printing, publications. So publications is anything from the 2 million copies of the Coles magazine that you pick up in a Coles or the Woolworths Fresh magazine every month, or the Qantas In-Flight magazine, or the Australian Women's Weekly, or House and Garden, you name it, 98% of every publication in the country we print. And then we also produce nearly every catalogue in the country, whether they be the Woolworths catalogue, the IGA catalogue, the Audi catalogue, you name it. We print every catalogue as well. I'll touch on that a little later as well. And finishing off with integrated logistics and household distribution. Household distribution is essentially the distribution channel for our catalogues. So we have 9,000 walkers every single week delivering catalogues to 6 million letterboxes across the country. And then our integrated logistics operation is a national footprint of 3PL, third-party logistics, storage, pick, pack, which we do for a lot of our major customers. So the power of our offer, no one in Australasia has the depth or the breadth of the value proposition that IVE Group takes to market. And we'll talk about some customer stats shortly, but it's very attractive. It has no gaps in terms of the major customers we target or we service. We really can provide them a fully integrated end-to-end marketing solution, as we put on the right-hand side there, our tagline, from idea right through to execution. That's the best way to describe the IVE business. We have a tier one customer base across a variety of sectors, which I'll touch on the next slide. Suffice to say, all rock solid. I actually can't remember the last time we had a bad debt. So it's a tier one customer base, and many of those customers, as you'll see with some of the statistics on this page here, have been with us for a long time. So starting on the left-hand side of this page in terms of customer penetration at 8%, that's Chemist Warehouse. Chemist Warehouse spend about $70 million a year for us. We do everything for Chemist Warehouse. Their catalogues, their House of Wellness publication, all their in-store fit-out, pricing, floor decals, window decals, you name it, everything you see in a Chemist Warehouse store right across the country. And for New Zealand, we produce the whole lot. So they're our 8% client. But you can see outside of that 8% client, a very nice spread of customers in terms of concentration, which is important. Customer penetration, this really validates, in my opinion, the power of our value proposition. The bulk of our clients are using multiple parts of the IVE business. Yes, some, 24%, are using one part of the IVE business. 76% are using more than one part of the IVE business, and you can see there quite a large percentage of clients are using many, many parts of the IVE business because they see value in that integrated offer. That middle column there, you can see we operate across a broad range of sectors, and within retail, a broad range of sectors within the retail environment. So we are a business that over the last 5 years has certainly become more heavily retail weighted to what we were 5 years ago. And the long and the short of all of that, I think our value proposition that we take to market, the way we run our business, the culture, our operational footprint, the quality of how we service customers and what we produce has resulted in relationships with our customers that are incredibly long. Just like the tenure of our staff is, we have a very low staff turnover for a business that has 2,000 people. So that's a really nice slide, and validates a number of things about the business and important customer metrics. If I just move on to now the FY24 first half results, without getting too complicated, a couple of years ago, our only competitor really in the catalogue and publication space, a company called Avato, went into administration. They were an ASX listed business. So we did a deal with the administrator to acquire selected assets of that business, and over the last 18 months have spent roughly $50 to $60 million integrating their $140, $150 million of revenue and some of their equipment into existing IVE footprint. That integration is now complete. In fact, it completed ahead of schedule. But just a context for people that don't know or are not familiar with the company, that is what the reference to Avato is. So in our half-year results, Our material gross margin was up, EBIT also up on what was a record first half year in FY23. And in the half, we also incurred a $5.6 million loss at an Avato site, which is the final site for us to shut down. So that's a $5.6 million non-recurring loss, which I'll pick up on the next slide. We've also fortunately seen a reduction in some input pricing through COVID. We had, like a lot of businesses, significant increases in, I think we buy roughly $350 million worth of paper a year. Most of it comes out of Finland from sustainable forestry. But we had massive increases in paper costs, electricity, freight, you name it, like a lot of businesses through COVID. So we've certainly seen some relief as we've come out of COVID the last 18 months, which has improved our material gross margin, which I'll touch on, and that flows through to NPAT at the end of the day. Our operating cash flow has improved again, but we've had a lot of cash outlays, but I'll touch back on that when I talk about dividends and just general cash flow shortly. I won't touch on growth initiatives on this slide because I'm going to do it in a couple of slides' time, but I'll move straight to the financial dashboard for the half year. And let's go to the right-hand side, or not quite, $506 million worth of revenue for the half. And on the right-hand side, what we've done is normalised our result there for that $5.6 million one-off non-recurring loss that we had at this remaining Avato site. So if you normalise for that $5.6 million, essentially our EBITDA was up 13.3%, our NPAT was up 9.4% on PCP to 26.6 million, and our earnings per share up 5.1% on PCP to 17.3 cents per share. And our EBITDA margin improved from 12.9% to 13.7%, in part driven by that increase in material gross margin, which is cost of goods sales less cost of goods sold, that increase of 2% in MGM, which is important. And we declared a fully franked dividend of 9.5 cents per share. Since we listed in December 2015, we've paid $157 million in fully franked dividends since December 2015. And that's with a year on the sidelines, because through COVID, we felt it was prudent not to pay a dividend in 1 year, which we didn't. But outside of that, we've still paid $157 million of fully franked dividends, which equates to $1.13 fully franked, $1.13 fully franked per share since we listed in December 2015. It's a very high cash generative business. Just moving on to a couple of growth initiatives. I'm not sure anybody has heard of the name Lasoo, but Lasoo is an e-commerce marketplace that we put probably with losses and capital expenditure between $15 and $20 million into over the last 2.5 years. It is essentially an e-commerce marketplace. You can order, if you look at the far right hand column there, you can order off 180 retailers anything you want in the one Lasoo basket. It is essentially an e-commerce marketplace. So it's fair to say the business it still is in its infancy. We're very pleased with the progress of the business. And as the last two bullet points say on this page, we are ahead of the original business plan we set for ourselves. So as a business, we're now looking at options for how we might look to further invest and grow and amplify the Lasoo business. So I think it's a watch this space. And then on the bottom right-hand corner, you can see a variety of the types of categories and where the spend is coming from. But we've gone from, I can't quite see this with my glasses, but We've gone from when we launched in August 22 to 30 odd retailers to December 23 having 180 retailers live on the site. And a lot of those retailers are brands that all of us would know. So yeah, watch this space on the Lasoo front. Moving on to packaging. Packaging for us is what we would call a natural adjacency. Just like brand activations that I talked about earlier brand activations is roughly $140 million part of our business. It started when we bought a business in 2014 that was turning over $14 million, and we've taken that small acquisition of $14 million in Sydney and turned that brand activations business into a much more powerful business across New South Wales and Victoria that is now, as I said, roughly 140 of our $1 billion of revenue. And our strategy in packaging is essentially the same. The folded carton section, so we're not talking corrugated boxes here. It's not your Amazon box or your brown carton. We're talking the types of packaging you can see at the bottom right-hand corner of this slide. It's folded cartons, fibre-based, which is obviously the world is moving to fibre away from non-renewable resources like plastics. And for us, it's an $800 million market. It is a natural adjacency to us because it dovetails in with existing printing equipment but needs additional equipment around die cutting and gluing and things like that without getting too technical. And at the end of October last year, we paid $35 million to buy what we would call a cornerstone or a beachhead acquisition in this part of the packaging sector, a business called JackPack in Keysborough in Victoria. And you can look at the pie chart there. JackPack today at $45 million of revenue only has 4.5% of the market. And when I get to the next slide, our primary focus in growth for packaging and growing this part of our business will be organic. We're going to build on the capacity that the JackPack business has in Victoria to take the business to roughly 60 million. And then you can see the bridge there in New South Wales with further investment, phase 1 and phase 2. Our goal over the next 3 to 5 years is to take what we bought in October last year, a $45 million business, to $150 million business. And we think the sector thematics that I referred to on the previous page, that pie chart, it's still quite a fragmented market. Some of those larger ones there are owned by international companies, and we think leveraging our existing IVE customer base, our logistics capability, our expertise, the quality of the business that we've bought, that we can really look to grow this part of our business just like we have done in the brand activations example that I gave you previously. So this is a really exciting initiative for us. We would have executed on this a little earlier, but when Avato went into administration, it was all hands on deck to deal with that at the time, 18 months ago, so we had to put our move into packaging off by about 6 to 9 months until we could wrap our arms around the Avato administration and then subsequent integration into the existing IVE business. Finishing up with FY24 outlook and guidance, so we reaffirmed at the half year what we communicated in August for guidance for the full year and also at the AGM in November. And that is for the full year, we've now included JackPack. We're guiding $127 to $132 million of EBITDA, following that down to $41 to $44 million of net profit after tax. That excludes the loss from Lasoo, which this year will be $3.9 million, which actually is an improvement on last year. The loss is smaller, so to speak, and we're now through the final phase of restructuring and integration costs with the Avato acquisition, which is also reflected in the CapEx numbers on this page as well. We've always been focused on maintaining a strong balance sheet, and at 30 June would expect our balance sheet to be 1.2 times EBITDA or 1.5 times pre-AASB 16 EBITDA, which is what has been our internal benchmark over a number of years. So we've gone through a period from a cash flow perspective of a lot of heavy lifting. In terms of the Avato acquisition, didn't cost much to acquire it, I might add. The cost was in the integration at the end of the day, integrating $150 odd million into our existing IVE footprint, which is now complete. So yes, we're on track for a very strong year and good year-on-year growth again. Probably finish on these metrics. Yes, the business has been around for 103 years. Since we listed in December 2015, our revenue for FY16 was just under 400 million. This year it'll be $1 billion. And over the same period, our earnings have doubled. We paid $157 million worth of fully franked dividends, and our balance sheet remains strong. So I'm really proud to be the chairman of what was a family business, now public, and a wonderful team of 2,000 staff that we have that are very loyal and take a lot of comfort in the power of the value proposition we take to market in the marketing communication space. It is unparalleled. Even at a global level, it's unparalleled. So it's been an interesting journey as a public company. Only ever having worked in a private family business, I've learnt a lot. But it's been a good one so far. So thank you again for your time this morning and the opportunity to present the IVE Group business to you. You don't want me to go through the disclaimer, do you? No?
Thanks, Geoff.
That's good.
I want you to start by, again, just talking through the growth of the company since you lifted it in 2015. I think it's such an important point.
Yeah, sure. I think the growth, the journey of diversification started 20 years ago. As a family, we formed the view that we needed to have more scale and we needed to be more diversified, and that we could not be essentially a one-trick pony. We couldn't just remain a small, so to speak, family printer. So really it's 20 years ago we embarked on a journey of a growth and diversification, and that's been a combination over the last 20 years of strategic acquisitions and organic growth. And on every occasion, it's been, at its core about broadening our offer. Some of them have been strategic acquisitions. Some of them have been straight bolt-on acquisitions where we've bought the business, shut it down 5 minutes later, integrated the revenue, unlocked the synergies. We've done a lot of that type of stuff over the years. I'm not quite sure how many acquisitions we've done over the last 20 years, but it's been quite a few. But it's been a combination of growth, acquisitions and strong organic growth.
And you had a slide up earlier demonstrating, the clients that obviously you operate with. I mean, it's probably one of the best tier one select clients.
Yeah, it's a fantastic client base. Yeah, look, they all pay their bills. And despite at times what people think, it can be counter. When the economy tightens, like the clients we have, if you want to drive foot traffic or you want to drive online traffic, all of our clients have the capacity to spend money to do it. So if you're Coles or you're Woolworths, whoever you are, and maybe there's a little softer retail environment, if they so choose, they can invest. It doesn't necessarily mean it's in our business. It could be an outdoor, media or other things, but they all have the capacity to invest if they want to drive consumer spending.
Another question came through here. And how is the current pipeline of work looking?
Oh, look, the pipeline across $1 billion business, we're always defending something, but we have a very good track record of client retention. One of those slides had the average tenure of clients at 12 years, I think. So we've got clients that have been with us for, like if you took Westpac have been a client of ours for 8 years. We have 20 staff full-time based on site at Westpac, like we do at Vodafone and a number of other clients like that, manage Commonwealth CBA, managing the total category for them. So we have a good track record of retention, and right across the business we always have a pretty healthy pipeline. We're always working on something.
And you talked a bit earlier about your e-commerce platform, Lasoo. It had been a bit of a prominent child, but also probably a huge opportunity going forward as well.
Yeah, look, we inherited Lasoo when we bought part of a business called Salmat in 2020. And Lasoo, all Lasoo was a website that hosted digital catalogues. So it's essentially the Woolworths catalogue that you may have seen. It was the digital version of that catalogue. But it had 200,000 people coming to that site every month. So we looked at that and we thought, well, it's not really adding a lot of value as a static digital catalogue site, but it has 200,000 people consumers coming to it a month. How do we monetize this? How do we commercialise this? And that's what we decided to do, was to turn Lasoo into an e-commerce marketplace. So actually, other than the name Lasoo, and we do still host some static digital catalogues, the new Lasoo that we launched in October 22 is completely different to what the old Lasoo was.
And again, you mentioned, was there a question there, sorry? You talked earlier that your focus is trying to grow organically, but M&A is also a part of that. Any particular targets on the radar at the moment? Or?
Look, we get approached a lot because we know we have a track record of acquisitions and completing acquisitions. We're very well respected. We play with a straight bat. That's not to say we're not clever, but we do get approached all the time from companies to see if we would consider acquiring them. And then on occasions we obviously approach companies and see or express an interest in acquiring them if we think it's a good strategic fit. For us at the moment, our primary focus is on growing that packaging sector for us organically. But if there were to be, if I could use the term, opportunistic acquisitions, we would contemplate that. We want to maintain a very strong balance sheet, so the acquisition metrics would have to stack up pretty well for us to entertain an acquisition at the moment. But look, we've done a number of opportunistic acquisitions over the years that have paid for themselves very quickly. So no doubt over the next couple of years, if things do tighten up a little bit more, we'll have some of those opportunities come across our desk again.
And maybe just to finish up, Geoff, you pay healthy dividends. Just remind us again that what you paid over the last.
Yeah, look, our dividend policy is 65 to 75% payout ratio of underlying earnings. So I think Tony's at the back of the room, our head of investor relations. I think our dividend yield on average since we listed is around 9%. And as I said earlier, we've paid $1.13 per share, fully franked, since we listed, or equated to $157 million in total dollar terms since we listed, and that's with a year on the sidelines. So we do generate a lot of cash. We've had a lot of cash going out the door with the initiatives we've had on the go the last 18 months, but you can see at June 30 we're still projecting our balance sheet to be in good shape. So it's getting that balance right.
Pretty impressive numbers for where I am. Geoff, many thanks for your presentation.
Thank you everyone for your time. Thank you.